We're Team 12.2, and we're in charge of Stir Fry Palace, a 3-4-star hotel situated in the city center. We have 200 standard rooms and 50 premium rooms, as well as a 125 seats restaurant with an adjoining 50-seat bar lounge section. It also possesses a 2,000 square feet conference and event space for up to 200 people. The objectives given to us by the owner were the following: achieve and maintain a level of guest satisfaction equal to or higher than our competitors, achieve and maintain an above fair market room share and an ADR equal to or higher than our competitors, and finally, generate an annual gross operating profit superior to 25% and a return on equity superior to 8%. To start our investments, we reviewed the documents related to last year's report, and we thought business travelers were a very good opportunity as last year's government tax incentives had successfully attracted 12 companies to move into the area this year. In addition, we wanted to attract large groups as they represented 11% of the occupancy for weekdays and weekends in the first 2 quarters.
Firstly, we looked at the areas that the hotel had been unable to fund refurbishments or capital investment projects, and we decided to focus on that. Additionally, according to the document property description, none of the 3 to 4-star properties within the area had any advantage in facilities or refurbishments. Therefore, the quality of all the properties were very similar. We decided to invest $181K in refurbishments with soft good redo in bar lounge, lobby, and public areas, front desk, and meeting rooms as well. We also had contract cleaning and services for our premium and standard rooms in order to reach a better quality. We also decided to invest in a business center, a lobby kiosk, a travel and tour desk, and valet parking in the very beginning. As we were targeting groups and business travelers, we figured out that the business center would probably be a key facility to drive revenue up. In February, we would have the lobby kiosk, travel desk, and valet parking ready and available, while the business center would be ready by March. Clients were clearly satisfied as they thought that our facilities fit their requirements and that our facilities also have shown improvement throughout Q1. This also means that we will not have a budget to invest in facilities such as a themed restaurant, spa, and fitness center anytime soon. But since we already have 1 restaurant, an exercise room, and a pool, those facilities are probably not necessary for us. In March, we decided to start a soft goods redo for our bar lounge. We wanted to finish it before the high season started, since a well-developed bar is an important source of revenue. Moreover, our lounge bar had only 60% on the reputation management grid, which we wanted to change since we were aiming for high quality in our establishment. However, as we spent most of our budget so early on investing in so many facilities, we would not be able to invest in another facility until May. In May, we would invest in our last facility, which is the retail shop. We still refurbished for $88,000 for lobby and public areas, as well as our front desk and associate facilities. This is to have optimal quality and fully prepared for our high season. As high season started, we had very minor refurbishments and did not invest in any more facilities. Soft goods redo for lobby and public areas, front desk, and environmental program were made for a total of $58,500 as our reputation was starting to drop. We didn't refurbish in August as we didn't want to make any changes when we were having our highest occupancy. While in September, we decided to make new investments to prepare for the end of the year, as this period is usually when most business clients and large groups book more, and we needed to attract them a maximum with our facilities. At the end of the simulation, our total revenue from rentals, including the retail shop, travel desk, and valet parking, adds up to $47,400 and $53,000 for the business center. Well, this is not exactly ideal as we invested in over $350,000 for these facilities.
In the first quarter, our hotel brand value increased dramatically compared to the last year. We have followed a value-based strategy and increased our quality to make our hotel more attractive. As a result, our occupancy increased by 5% and our reputation improved a lot as we invested in refurbishment and facilities. We also decided to keep our room rate competitive. Our objective this quarter was to enter the market smoothly and get a feel for it. In the end, we reached an MPI of 130.9 and an ADR of 91.6. When combined, we get an RGI of 105.2, which is great. This results in us getting 11.29% of the market shares. In the second quarter, We kept our value-based strategy and tried to position ourselves in the good price with good quality. We reached a balance between the price and quality. We lost 0.2% of the market shares, but we achieved an occupancy of 66.5%. Although our MPI decreased by 5 points, the ADR increased by 5 points, which kept our RGI above 1. In the high season during the third quarter, we increased the price by a little while our quality dropped slightly, resulting in a 0.5% decrease in the market shares. As our price increased, our hotel occupancy rate decreased by a little. However, our ADI reached the highest it has ever been, which was beyond 100. Moreover, there was an increase in RGI by 3. In the first quarter, we were reaching our goal, which was mixing low prices with good quality. This resulted in market shares of 10.87% and with high percent of occupancy in the market. We also ended with an impressive RGI of 106.7, which was constant throughout the whole year. In the end of the year, we were not able to obtain the group request as our competitors set a much lower price than us. However, our occupancy still remained at a high percentage because of our low prices and high quality strategy.
In the first quarter, we decided to use a different channel distribution pattern than the expected channel demand percentages. We invested more in our direct channel distribution because it cost the least compared to GDS, which had a commission of 50%, OTAs, which had a commission of 20%, and wholesales, which had the commission of 35% per room night. We wanted to invest more resources in direct channel distribution method, which is why advertising also invested heavily in it. Unfortunately, our occupancy percentage remained around 60% between the months of January and March, as seen here. We then changed a different channel distribution pattern to perfectly match the expected channel demand percentages in April to see if it had a positive impact on the occupancy. As a result, along with the change of other factors, our occupancy grew by 10% over the next 2 months. For the remaining 3 quarters, we kept the same channel distribution pattern and maintained an occupancy index above 1. We have set trigger points for all market segments. We adjusted them according to the market share according to the previous months. We kept our group segment relatively low since we had a large market share for groups, as indicated by the group market penetration index. During the high season, we decided to increase the upper boundary to above 75%, as we had an average occupancy of 80% in this high season.
For the relationship between marketing and the advertising expense and the room revenue, our spending reached its peak during the middle of the high season and during the end of the year. This was done on purpose in order to make sure that we advertise well during the high season to maximize our occupancy and to prepare the market awareness for the next year. And in December, we decided to cut the marketing expense to ensure the profit.
So now we're going to look at our pricing strategy. For the first quarter, we first look at the net room rates of the previous year to determine the prices for January. ADR for premium rooms last year for quarter 1 was at 180, bar standard at 150, promotion guaranteed, qualified small groups in contract at 130, and tour and large groups at $120. Considering background information saying that there is improving economic conditions and distribution costs, we increased 10% from the net rates of bar standard from quarter 1 last year to set prices in January this year. Premium prices were set very high at $295, as we only had 31 rooms out of order, and we had very little premium rooms available for guests. Group, tour, and contract rates were low at 110 and 115 respectively, as we were aiming to attract large groups with our value-based pricing strategy and maximize occupancy pricing strategy. Weekend rates were set $5 lower than weekdays, as there is less occupancy during the weekends, and a lower price would attract more guests. After analyzing our prices with competition and having refurbishments and facilities improvements in January, for February and March, we slowly increased our prices $10 per month for all rates. Our ARI was seen to rise to 93.8 in February and 94.4 in March. The RGI average for the first quarter was 105.2, and occupancy is much higher than its comp set, with an MPI at 113.9. Performance shows that our decisions has attracted the correct group of guests, which is making the hotel outperform the comp set. At the end of the first quarter, we saw a drop in our occupancy due to our increased prices. For the beginning of the second quarter, we lowered our prices as a small correction of $10 per rate to improve our MPI back to 114.9. In May and June, previous trend shows that there's an increased occupancy during this quarter, so we decided to increase prices 10% every month after April. Quarter 3 is high season, and with all the refurbishments and facilities implemented, we charge our price very high at $240 for bar rate, but $175 to $180 for group rates to maximize our occupancy in July. We increased an additional $25 for the bar rate, but lowered $10 for group rates and tour rates in August, as most guests during the period were transient guests. Performance shows that our pricing strategy was very good, as at the end of the quarter 3, all KPIs showed that we were again outperformed the market. The beginning of quarter 4 was the end of the high season, so we adjusted our rates for October accordingly. Premium rates were lowered to $270 for maximum rate strategy, but bar standard was lowered to $200 to maximize occupancy. We did not change group and discounted rates, as last year's data showed that there was the same amount of demand for these guests. Our prices seemed to be lower than the comp set, as our ARI was 94.7. Nonetheless, for October, our RGI was 108 due to the maximizing occupancy strategy, has attracted many guests, contributing to our high MPI at 113.5. We increased the prices 15% accordingly for November from our prices in October to match with the market rates. This has proven successful, with our ARI of 98.8, but RGI sacrificed as lowered to 104. We kept the same prices for December, as there was not a large change in the market demand, and we expected competition to lower prices as well.
To have a full overview of our performance, we conducted an analysis of our 3 main KPIs in comparison to the market. By keeping lower prices but higher occupancy than our competitors, we stayed aligned with our initial objective. The results gave us a high RevPAR and a high RGI of 1.066, showing how well we performed on the market. Compared to the objective set by our owner, we can say we reached our goal. Although our ROE reached only 5.57%, our occupancy exceeded by 6 points the market, and our GOP reached 37.26%, which is higher than the objective set. We also reached 10.87% market share, which is slightly below what we expected at the beginning. If we had to change anything, it would be adjusting prices according to the occupancy by using turbo points, in particular during high season, in order to increase the ADR to reach our goal. We also recommend investing in a spa and a themed restaurant to attract more guests and generate more revenue.